When your income crosses into the seven figures, you stop thinking like an employee and start thinking like an architect, not just earning but structuring. In this video, we are going to break down how $1 million owners can still protect and optimize their partnership income under the Big Beautiful Tax Bill or TLB3. Let's go step by step to understand what the headline got wrong and what actually changed under the law, to how one of our clients used this strategy to save over 200K legally, to the action plan for 2025, future planning beyond 2026, and the biggest mistake high earners should avoid. If you are a fund manager, real estate syndicator, private investor, or someone who's earning carry interest, this episode is for you. Let's dive in. You might have seen headlines screaming, Congress finally closed the carry interest loophole. It sounds dramatic, right? But here's the truth. Those headlines never tell the full story. What they are talking about is Section 1061 of the tax code, the rule that governs something called carry interest. Now, carry interest is basically how private equity fund managers and some real estate sponsors get paid. They take a share of the profit from an investment, usually 20%, and if the investment is held long enough, that income is taxed at capital gains rate, not ordinary income rate. Capital gains rate can be as low as 20%, while ordinary rate can reach 37%. So this difference can mean hundreds of thousands in savings. Politically, this been called a loophole. In reality, it's a rule, and as of TLB3, it's still alive. The Big Beautiful Tax Bill didn't eliminate carry interest. It simply reaffirmed the importance of timing, documentation, and economic substance. So here what we will cover today. Part 1, what really changed under TLB3. Part 2, a client story that shows how it works. Part 3, your action plan for 2025. Part 4, future roofing beyond 2026. Part 5, common pitfalls to avoid. And finally, Part 6, the big takeaway. Stick with me until the end. I will share a bonus checklist that can save you 6 figures in taxes if you are earning 7 figures or more. Let's start with the foundation. The Big Beautiful Tax Bill or TLB3 did not change the core carry interest rule. The 3 years holding period for long-term capital gain under Section 1061 remains the same, but TLB3 and the IRS guidance that follow make the rule tighter in practice, and this is where most high-earners get caught off guard. Here are the 4 things that actually matter now. First, the IRS now look through partnerships. If your investment is held inside multiple layers of partnership, the IRS doesn't stop at the top layer anymore. They look through the underlying asset. So if your fund sells a business or property after 2.5 years, even if your top entity existed longer, you will lose long-term treatment. 2. The difference between capital interest and profit interest. A capital interest means you invest your own money. A profit interest means you are rewarded for managing the investment. The IRS wants crystal clear documentation separate those two. Only true investment risk qualifies for capital gains treatment. 3. Fee waivers and economic substance. Some fund managers trying to convert management fees into carry interest by waiving their fees in exchange for future profit allocations. The IRS is cracking down on this unless it involves genius risk and deferral, meaning you actually have to wait to get paid and risk losing it if the investment fails. 4. Salt workarounds still work. High tax states still limit personal deductions for state taxes. but you can elect to pay those taxes at the entity level, a move known as the pass-through entity tax or PTE. This election let your partnership deduct state tax fully, a huge benefit for investors in places like California or New York. So no, TLBT didn't kill carry interest. It simply raised the standard for how well you need to track, structure, and document it. Now that you understand the new landscape, let's make it let's walk through an example of how one high-earning client structured her partnership to keep her capital gains advantage legally and efficiently. Meet Priya, a managing partner with a boutique private equity firm based in Austin, Texas. Her firm focuses on software and commercial real estate investment, and she earns two types of income. One is management fee, the regular cash flow for running the fund. Two, carry interest, the share of profit when the investment pays off. When TLB3 passed, Priya caused worry. She had heard the same headline. Carry interest is dead. But we explained the rule hasn't changed. The proof has. Just here's how we help her adjust. And you can think of this as your step-by-step playbook. Step 1. Review every holding period. We built a timeline showing each investment purchase and projected sale date. Any investment under 3 years was flagged. We updated fund agreement and lockup periods to ensure no sale happens before the 3-year mark. Step 2. Separate her entities. Previously, her fund LLC handled both management fee and carry interest. We split them. So Service LLC, which is an S corp, receives management fee, taxed as ordinary income. Fund LLC is a partnership, held her carry interest, taxed at capital gain rates. Two entities, two clear income types. Step 3. Clarify the operating agreement. We rewrote the fund agreement to clearly show who invested money, capital interest versus who earned carry profit interest. This avoids any risk of IRS treating her carry as a disguised service fee. Step 4. Leverage the SALT workaround. Although Texas has no income tax, some of her investors were California residents. We set up entity-level tax election there to restore the deduction for state income tax. Step 5. Audit-ready documentation. We create a digital carry interest binder with K1s, operating agreements, fee waiver proof, capital account reconciliation, valuation report. Every year updated and ready for an IRS review. The result? In 2025, Priya Fund sold her company after 3.4 years. Her carry interest portion, the 1 million taxed at 20%, is up 37%, saving her around $210K, all within the law. So, what can you learn from Priya's case? It's simple. Structure matters more than strategies. And this brings us to the part most million-dollar owners care about, the step-by-step strategies for tax year 2025. Your action plan right now. If you earn 7 figures from partnership, co-investment, or carry interest, here is your playbook for tax year 2025. Think of this as a checklist portion of our video. You can even pause and take notes here. These are the building blocks of your tax advantage. Step 1. Track everything. Use a spreadsheet or fund management software to track acquisition date of every asset, partner contributions, holding period timeline, target sale date. The IRS checks the clock at the asset level, not entity. Step 2. Separate income streams. Never mix your service income with your investment income. File separate tax returns for your fee entity and your carry entity. Step 3. Strengthen your agreement. Your partnership agreement is your shield. Spell out who contributed capital, who earns profit interest, and how gains are allocated. If it looks vague, fix it before an audit does it for you. Step 4. Review fee waiver. If you are waiving management fees for carry, ensure it has real risks and timing. The IRS knows the strict well, do it right or don't do it. Step 5. Make the PTE election if eligible. If you live in a high tax state, check whether your partnership can elect to pay tax at the entity level. This one election can save you tens of thousands per year. Step 6. Annual partner review. Revisit allocations, capital accounts, and tax position every year, not just at filing time. Partnerships are living organisms. They change and your documentation should keep up. Now that we have covered what to do this year, let's zoom out and talk about the future. What happens after 2026 when the current tax rate sunsets? That's where advanced planning comes in. After 2026, the top RA income tax rate is expected to rise again, but long-term capital gain rate will likely remain longer. That widening gap is your opportunity. Here's how to plan for it. 1. Installment sales. If you sell a fund interest or partnership stake, structure it as an installment sale under Section 453. That way, you spread your taxable gain across multiple years, lowering your bracket each year. 2. Charitable remainder trust. If you are expecting a large carry interest paid out, move it into a CRT or charitable remainder trust before the sale. The trust can sell assets tax-free, pay you income over time, and give you a charitable deduction upfront. 3. Transfer GP, which is general partner interest, to a trust. Shift your general partner or carry interest unit to a grantor trust before appreciation. This removes future growth from your estate while keeping control over management. 4. Section 754 election for basis step up. When a partner sells or dies, make a Section 754 election to adjust basis. That means the new partner's share of future depreciation or gain is recalculated, often saving thousands in future taxes. These are the moves high earners use to stay ahead. They don't react to tax law changes, they plan for them. And that brings us to the most important part of the conversation, the pitfalls that can ruin your entire strategy. These are the common mistakes for our part 5 that I've seen even sophisticated investors make. 1. Selling too early. Sell before 3 years, and it's all RA income. Set a reminder, track the holding period, and build lockup periods that align. 2. Ignoring participation records. Material participation affects the 3.8 net investment income tax. If you are active in the partnership, document your hours. It could save that extra surtax. 3. Using cookie cutter LLC agreements. Boilerplate templates don't protect you. Your partnership agreement must reflect the actual economy, or the IRS can ignore it. 4. Mixing service and investment income. If your management and carry are paid from the same entity, you risk everything being taxed as ordinary. 2 entities, 2 income types, it's that simple. 5. Missing election or deadline. Late or missing Section 754 election or missed K1 and unfiled disclosure can disqualify you from benefits. Have a compliance calendar and assign accountability. Alright, we have covered what changed, how it works, and your action plan, future strategies, and what to avoid. Let's bring it all together. Here's the truth. TLB3 didn't remove the private equity advantage, it clarified it. the law still allows carry interest to be taxed at long-term capital gains if the investment is held more than 3 years, the documentation is clear, and the income reflects real estate acceptance. If you understand the rules, you can keep one of the most valuable advantages in the entire tax code. For $1 million owners, partnership structuring isn't about loopholes, it's about alignment. You are aligning your income with your effort, your risk, and your time horizon. And that's what separates reactive owner from strategic wealth builder. So if you are a high income investor, fund manager, or real estate operator, take the time now to review your structure, because when rates rise again, say 2027, the one who planned will still be paying capital gains rate, while everyone else pays double. That's the difference between hoping for a tax break and building them into your structure from day one.